Welcome back to Talk Tickers. Today, we are diving straight into the Q3 2025 earnings for Gambling.com Group, that's GMB, which they reported pre-market on November 13th. And this one is, well, it's a fascinating study in contradiction.
It really is. You have management on the call, celebrating record revenue, talking up their execution, really painting a picture of strength.
And yet, the second those numbers actually hit the street, the market it reacted like the whole business was falling apart. A huge sell-off.
A massive sell-off.
Absolutely. So we're calling this deep dive the engine swap. It really feels like management is trying to switch from this, very volatile SEO-reliant affiliate model
to something much more durable, something data-driven.
Exactly. So our mission here is to figure out if this is a genuine pivot to a healthier business, or if the market is right to be so worried about these headwinds that are, frankly, outside of their control.
That's the core tension, right? How can a company post a huge operational beat and still see its stock get hammered by 23%? The market is sending a really clear signal here.
Okay, so let's start right there with that tension. Let's look at the numbers. The street obviously hated the revenue, but there's a genuinely shocking positive on the profitability side.
Oh yeah, the non-IFRS adjusted EPS came in at 26 cents.
Which was just a massive beat. The consensus was what, 16 cents?
Around 16 cents, yeah. So a staggering 62% beat. I mean, that's the definition of operational excellence.
Right.
It tells you that even if revenue is slowing down, they are just squeezing every last drop of efficiency out of the dollars they do bring in.
But nobody cared.
Nobody cared. All the focus immediately went to the top line. Revenue came in at $39 million, missing the $41.1 million consensus.
And even though that's still 21% growth year over year, that miss just signals a serious slowdown in their main business. That's what spooked everyone.
And it flowed right down to the margins. Adjusted EBITDA margin dropped pretty sharply from 39% a year ago all the way down to 33% this quarter.
So the verdict from the street was just swift and brutal. They saw the revenue miss, they saw the margin compression, and they completely ignored that huge EPS number.
They priced in all the risk and focused only on the guidance cut that came later. Predictability is king right now.
Okay, let's get into the mechanics of that. Let's break down what management calls their dual engine strategy. Engine one is the legacy business, right? The marketing services.
Right, the affiliate business. It's still the bulk of the company, pulling in $29.8 million, so about 76% of total revenue.
And there's the problem. That revenue is basically flat year over year.
And worse, the new depositing customers, the NDCs, were down 13%, just over 101,000. That engine isn't just slowing, it's sputtering.
But if engine one is sputtering, why isn't management panicking?
Because engine two is absolutely roaring. This is the whole strategic pivot. Their sports data services segment, which they got from acquiring OddsJam and OpticOdds.
The revenue there did what?
It quadrupled. Year over year, it quadrupled to $9.2 million.
Wow. So that means the data business is now almost a quarter of the entire company's revenue.
24%. And that's up from basically nothing a year ago. I mean, this shift is happening fast. It's violent. And it's very intentional.
And what's really interesting is how that changes the stability of the business.
Exactly. Subscription revenue, which is almost all from data, is now 24% of the total. Sure. And if you add in the revenue share deals, their total recurring revenue is now 49% of the Q3 total.
So nearly half the business is now recurring revenue. That's a huge change from a purely transactional model.
A massive change.
Okay, but let's talk about that margin drop from 39% down to 33%. Management said it was higher marketing costs. Is this just inflation or is something else going on?
No, this is a strategic choice. They are actively spending money to escape their dependency on Google.
So they're funding a traffic diversification strategy.
They are. They're trying to rely less on organic search, which is, free traffic, by pushing hard into more expensive channels like paid ads and partnerships. They know being so dependent on Google is a major risk, so they're willing to take a margin hit now to build a more resilient business for the future.
So they're choosing to trade cheap, volatile traffic for more expensive, but hopefully more stable traffic.
That's the play. And despite that spend, they're still a cash machine, $9.6 million in adjusted free cash flow.
And they're putting that cash to work too. They bought Spotlight.Vegas for $8 million in cash. They paid down some debt.
And importantly, they bought back their own stock. Over 500,000 shares for $4.7 million. That's a huge signal of confidence from management that they think the shares are cheap right now.
Okay, let's drill down on the core problem here. The reason for all this spending and pivoting, management was really clear. The problem is Google.
Very clear. They said that since July, Google's search algorithms, especially outside the US, have been favoring what they call low-quality spam content.
And that's pushing their own high-quality sites down in the rankings.
Exactly. They said this is the direct cause of the flat marketing revenue and that 13% drop in NDCs. This isn't some slow decline. It's a very specific acute injury from a search algorithm change.
Which is why they admitted they're behind where we and our analysts thought we would be.
But I have to stop you there. Management keeps saying this is temporary. But if this has been going on since July and they've had to cut their full-year guidance because of it, how temporary is temporary, really? Is this not a permanent shift?
That is the multi-million-dollar question, isn't it? The entire gap between what management believes and what the market believes is centered on that timeline.
Right. Management says they're past the worst of it.
Yeah.
That they saw rankings start to improve in late October.
But the market is basically saying, show me, don't tell me. The recovery is completely out of their hands. It depends on Google's anti-spam team deciding to fix this.
And that external dependency is just a killer for the stock. If you run a big website, you know these Google updates feel less like fine-tuning and more like random earthquakes. They're trying to build a new house while the ground is still shaking.
And their response to that shaking is to accelerate this pivot. They now expect that in Q4, for the first time ever as a public company, non-SEO channels will bring in more revenue than SEO.
That's a huge, expensive, but probably necessary change.
So if the marketing engine is in trouble, the data segment has to be the lifeboat.
Or the future cruise ship, really. And that Odds Holdings acquisition is already paying off big time. This is a high-margin, recurring revenue business in a multi-billion-dollar market.
Let's talk about the enterprise side of that, Optic Odds, the B2B solution.
This is designed to help sportsbook operators cut costs. In a slow-growth world, operators are desperate for efficiency, so it's a really compelling product right now.
And they're doing more than just simple data feeds.
Oh, way more.
Yeah.
They're becoming mission-critical. They talked about providing bet settlement services, which is huge.
Bet settlement. So they're actually verifying the results of bets and settling the books for the operator.
Exactly. That requires deep integration, a lot of trust. They're also helping price complex bets like same-game parlays, and they're looking at adding early cash-out functions. They're embedding themselves deep in the operator's workflow.
And this is where it gets really interesting, right? The prediction market angle.
Yes. Optic Odds is working with Wall Street firms and market makers for companies like Kahi and Polymarket.
For those who don't know, those are platforms that use bets, essentially, to forecast events like elections or economic outcomes.
And they need massive amounts of real-time data to work. Management pointed out that a lot of their rivals are steering clear of this space because of regulatory uncertainty. That's creating a big competitive advantage for JAM in a really fast-growing area.
But all that future potential couldn't stop the immediate pain. The guidance reset was the real killer for the stock.
It was. They cut full-year revenue guidance down to about $165 million. That was from a range of $171 to $175.
And they cut adjusted EBITDA down to around $58 million.
It's a cut, but you have to put it in context. The new guidance still implies 30% revenue growth and 19% EBITDA growth year over year. It's not like the business is collapsing.
And they set new targets for 2026. Low teens growth for marketing, high teens for data, and a return to mid-30s EBITDA margins.
Right. There was one other headwind they mentioned, though, in the UK, regulatory risk.
Yes, the gaming duty. They expect the UK and Ireland to be flat next year because the government might raise taxes on gaming.
And the connection there is key. If taxes go up, operator profits go down, which means the lifetime value of a player goes down. And if a player is worth less, JAM can't charge as much to acquire them. It's a direct hit to their affiliate margins.
Okay, let's just recap the market signal here. The stock dropped 23.1% on earnings day.
On insane volume. 6.7 million shares traded. The long-term average is like 200,000. That's institutional panic.
And this isn't a sector problem. The betting ETFs, like BETZ, are actually up for the year. JAM is down 55%. This is a company-specific issue.
Totally. It's all about this SEO problem and the execution risk of this pivot. And you saw it in the analyst ratings. Just cuts across the board. Stiefel to 12, Truist to 7, Jefferies to 13. A total loss of confidence.
All right, which brings us to our This Is Not Financial Advice segment.
And we have to be absolutely crystal clear. This is not investment advice. We're just looking at the market dynamics here for educational purposes, thinking about how a trader might approach this kind of setup.
The volatility is just off the charts. It's extreme. And that creates some interesting opportunities, right? The market is pricing in total disaster for their SEO business. How do you use that fear?
You sell the fear to fund a bet on the growth story. The whole pitch is a defined risk bet that management is right, that the SEO bottom is in.
So how would you structure that trade?
Well, with implied volatility spiking to around 78%, you sell out-of-the-money January puts. That IV means the price of that downside insurance is super inflated. So you sell it, collect a big premium.
And then what do you do with that premium?
You take 100% of it, and you use it to buy long-dated calls, say for July 2026. And you target a strike price somewhere in that cluster of new lowered analyst targets, maybe $10 or $13.
So the logic is you're using the market's short-term fear, the expensive puts, to get a nearly free long-term bet on the structural growth story.
Precisely. If management is right, and the SEO problems are temporary, and the data business keeps growing, those calls could pay off handsomely. And if you're right, the short puts just expire worthless. It's a capital-efficient way to bet on the engine swap actually working.
Okay, so to wrap this all up for you, the central tension is this. JMB is aggressively trying to transform from this volatile affiliate into a stable, data-driven provider.
But the market is completely unwilling to pay for that future potential until the present headache, the SEO mess, is completely gone.
And here's the final thought for you to think about. Management has been buying back stock. They clearly think it's undervalued, but they have about $60 million in payments due for that Odds Holdings acquisition over the next 2 years.
That's a huge liability, $40 million in 2026 and $20 million in 2027. So the question is, will they keep using their cash to aggressively buy back stock at these low prices?
Or will that $60 million payment hanging over their heads force them to be more conservative, potentially missing this window to really shrink their share count?
That decision could really define the stock's path over the next year.
That's all we have for this deep dive. Thank you for joining us, and we hope you walk away better informed.